What's going on, my fellow wealth creators? Matty Guys here. In this video, we're going to be talking about front loading a dividend paying whole life insurance policy for high early cash value. This is a really powerful way to set up your policy, guys. There's a number of different benefits. It's exactly what I did for both of my policies. It basically supercharges our policy, and you'll see what I'm talking about, because I'm going to, first off, we're going to break down, like, what does this even mean to front load a policy? Why would we want to do it? How does it work? And what do the numbers look like? So I'm going to show you my actual policy, and so you can see the numbers and how it impacts the policy over the long run. And this is also like a complete 180 of what mainstream financial media tells us and tries to teach us about dividend paying whole life insurance, usually calling it, a terrible investment. It's a horrible place to put your money. You don't get access to any of your money for 3, 4, or 5 years, whatever. And that's a half truth, because they're usually talking about traditional whole life policies that are not custom designed, but you can actually custom design these policies. And one way of doing that as part of the custom design is putting a larger amount of money into the policy in the first year to really supercharge it and get access to a lot of cash value very early on. When I set up my policies, I had access to almost 90% of my cash value within the first 30 days of the policy. It's freaking awesome, guys. If you're using these for emergency and opportunity funds, you want to implement something like infinite banking, whatever, it's really, really powerful. So let's get into it. I've got a few bullet points that I want to go through here, and then I'll show you a breakdown of my actual policy. All right, here we go. So first off, what is front loading? What does that even mean? Well, to keep it simple, basically all it is we're contributing a larger amount of money in the first year to a policy than what the annual premium is. I guess I should say base premium, but the way that I look at it is, for example, if you are comfortable putting $10,000 a month, saving $10,000 a month into your policy, let's use that as an example. Well, instead of $10,000 in the first year, maybe you have enough savings where you can put $50,000 into the policy in the first year and then pay $10,000 per year for however long you want afterwards. That's what a front load is. We can only do it one time. It's using a paid up additions rider from these, and every company is a little bit different with their single premium paid up additions rider, whatever. But that's what we're essentially doing here. We're just putting a larger amount of money into the policy in the first year. That's what we're doing. Now, why would we want to do that? Great question. Let's talk about the benefits of this. First off, it creates really high early cash value, guys. Like I mentioned, I had access to almost 90% of my cash value within the first 30 days of the policy. So even if, I don't want to skip ahead here. I was about to talk about policy design and higher base premiums. We'll get to that in a second. But suffice it to say, really high early cash value when you front load a policy. Here's the other benefit. It supercharges the policy as well, because we're able to start earning that uninterrupted, because these policies get uninterrupted compound growth for the life of the policy. Well, would you like to earn 3 to 5% uninterrupted compound growth on $10,000 starting or $50,000 starting, right? It's a pretty simple question. Obviously, the larger number that we start with, the better it's going to be for the policy, the better the numbers will be long term. So it really helps to supercharge the policy because we're starting with a much larger number. All right, so compound interest on a larger number, very, very powerful. What I was starting to speak about a second ago here is it also provides policy design flexibility. Here's what I noticed is even if you have to have a higher base premium with the policy, you still get access to a ton of cash value in the first year and beyond. Now, what I mean by that, if you're kind of new to dividend paying whole life insurance, I talk about this a little bit more in some of my other videos when I'm talking like going deeper into policy design. I'll link some of that training down below if you want to learn more about it. But basically, when we're setting up these policies, we're usually lowering the base premium and increasing the amount of money that's going into what's called paid up additions, okay? And paid up additions is what gives us access to more cash value. Typically, every dollar you put into paid up additions, you're going to get access to roughly 95% of that shows up in cash value, versus the base premium, at least in the beginning of the policy, very little of that shows up in cash value. Now, it does come back to you over time, but in the beginning of the policy, we're not getting as much, or we're not really getting a lot of cash value at all when we're setting it up primarily for the base premium, right? So base premium versus paid up additions. But here's the thing. So I set my policy up as an example. I did 25% base premium. I did 75% paid up additions. Okay. I know people that do 10% base premium and 90% paid up additions, right? But here's the thing: not everybody can do that because everybody's at a different age, health rating, how much they're able to put in the policy. Like everybody is so different that sometimes you're forced to increase the base premium so you don't mech the policy. That's a modified endowment contract, and what that does is it lowers the amount of cash value that you have access to in the first year. Okay, but if we add a if we front load the policy, even if we have to increase our base premium, we still get access to a ton of cash value, guys. I've run illustrations for this for a number of different clients that we weren't able to lower the base premium as much as, like my policy, for example, we had to have a higher base premium, 40-50% base premium. But because we were front loading the policy, my client was still able to get a lot of cash value in the beginning. So this is also, that's why this is another major benefit of front loading, is it actually gives us a lot of policy design flexibility. And here's the other thing. Some people want and actually would benefit from a higher base premium because they want more death benefit up front as well. Not to mention, typically the way that base premium works is you're going to get more dividends from the base premium over the long run than you will paid up additions. So that could help with policy performance long term as far as like what the dividend is. All right, which I should mention are not guaranteed, but these companies have always paid them. All right. So anyways, that's a major benefit as well. Also, here's another thing that was important to me is when we front load a policy, we're able to take it, basically move more of our savings out of the banking system. I've talked about this a lot. Let me full screen this so you guys kind of blocking some of that. But anyways, I've alluded to this before on other videos, is I don't trust the banking system whatsoever, guys. I don't want a large amount of money in the banking system. I just don't trust it. It's super corrupt. I want as little to do with it as possible. So this is these policies are a great place to store large amounts of capital for emergency and opportunity funds. And if you ask yourself, what is your money doing in the bank? It's very little. Like it barely earns any interest. We got high yield savings accounts at the moment, but how long is that going to last? Not to mention, you get so many more benefits in these policies than having it stuck in the banking system. And we're able to essentially just put our savings into a much more efficient savings vehicle where we get lots and lots of additional benefits. All right. So that's that. Let's see if I got enough space here. There we go. I'm not blocking too much now. All right. Next question. How much do we front load the policy? Well, it really depends on your current financial situation. How, what's the amount of savings that you have right now to move? Now, this is really important too, guys. Number one, obviously, is not financial advice. I'm just sharing my experience. But obviously, we don't want to be moving all of our money out of the bank, out of the banking system. That would be ridiculous. I didn't even do that. As much as I can't stand the banking system, I still have money in the banks for everyday expenses, 2 to 3 months, just in case something were to happen or whatnot. But I moved my working capital, emergency and opportunity money into these policies because it just wasn't doing much for me in the banks. All right. But how much you're able to front load is going to depend on how much you have saved, how much you comfortably saving on an annual basis as well. This is important because this will impact how much you're able to actually front load the policy, because there's only so much you can front load based on your annual premium. All right. That's kind of what I'm getting to right here. Can do a max of 10x the base premium. There's some companies that allow you to do 12x, but 10x is kind of the max. I don't know that that's really necessary. It's kind of a lot. I did, I think, 4 or 5 times my base premium, I think it was. I'll show you here in a second. But generally, at the minimum, we want to do at least double the annual premium. So again, if you're going to be doing $10,000 per year into the policy, that's what you're comfortable doing on a long-term basis. That's not going to stress you out. At least doing $20,000 in the first year. That's generally what I recommend if you're looking to supercharge the policy, get access to as much cash value as possible. All right, so it's just something to think about, but it really comes down to how much you're comfortable saving. What do you have in savings right now that you want to move out of the banks because you're not benefiting really? Actually, you're benefiting the banks and you're losing to inflation when it's sitting in the bank. How much of that are you able to move comfortably into the policy? All right. I think that's it for the presentation side of this. Let's head over to my actual policy here, and I will show you the impact of front loading and what the numbers look like. So here I am. All right, so this is my actual original illustration that I was approved for. I was 35. I'm 36 now. I'm a little over 1 year into my policy. Make sure you guys subscribe because I'm going to be coming out with a video here very shortly breaking down my annual statement and just sharing my first year experience owning one of these policies. It's been awesome. It's really, really cool stuff, guys. These things just provide so many benefits. It's awesome. So make sure you subscribe. I'm going to be coming out with that very shortly. But here we go. So I set my policy up. Here's my annual premium, $25,000 per year. Now, I'm not on the hook for $25,000 per year. Remember, I was talking about earlier the difference between base premium and paid up additions. I set this policy up about a 25-75 split. So the only amount that I'm actually on the hook for, I'll just show you here really. Usually make it a little bit easier than that. Okay, here is this it? Yes, here we go. So what I'm on the hook for that like I would actually get a bill for is just under $7,000 per year, but I can put up to almost roughly $25,000 per year at my discretion because of this paid up. Actually, this is a level premium here, but let's see. Oh yeah, no, that's it. Level premium, paid up additions rider. Okay, $18,145 above my base premium here. All right, so when you see this $25,000, that's just what I'm comfortable saving into the policy every single year, but it's not what I'm on the hook for every single year. Okay, so that's important to know. But what you'll notice here is my total lump sum of $95,000. So so I put a total of 120 right here in the first year. So I paid my the max first premium, and then on top of that, I added a lot more money to the first year of the policy because I want to supercharge it. I want to get access to as much cash value as possible. And I wanted to move as much money as I comfortably could out of the banking system because I wasn't getting any real benefits from it. Okay, so that was my total lump sum. And then on top of that, I had my first year's annual premium. All right. And what it resulted in was I had access to roughly about 104,000 within the first 30 days. A few months after that, it continued to increase. By the end of the first year, I had access to roughly about like before I got my dividends, roughly about 110,000. So, I mean, that's percentage-wise, like a pretty good amount of cash value that I have access to, guys. Not to mention, like I said, because I'm starting with a much higher number, this dividend, just the growth of the policy in general, my net cash value, the increase in net cash value every single year is going to be much better than if I just started with the $25,000 per year. It makes sense because I'm starting with a larger number. All right, so high early cash value, the increase in net cash value is very attractive as well. Look at this. By year 2, I'm putting in $25,000, all right, but my cash value is projected to increase by $27,000. All right. By year 5, again, I'm still only putting $25,000 in, but it's expected to grow by over $31,000. I almost said 11, 31,000. So what's happening is I'm putting $1 in, and I'm getting back $1.10, $1.20. So imagine if you were at the bank and you were going to deposit $100 into the ATM, for example. Okay, so you make the deposit, but all of a sudden you have access to $110 in your account. And then next year you deposit $100. Now you have access to an additional $120. Like how many $100 bills would you put into the ATM? A lot, right? That's why like I don't think of these things as like I'm getting a bill every single year, that this is an expense. I'm moving money into what I would refer to as my banking system, and it's becoming more and more efficient every single year. I'm getting my net cash value is increasing by far more than what I'm putting into the policy. All right. So yeah, I just think it's really powerful. Also, this is another benefit too, is that it front loading the policy generally lowers the amount of time that it takes to hit that break-even mark. So I think this one is 4 years. So my net cash value at the end of year 4 is 198, and I put in a total of 195. So this, when you front load the policy, you're going to typically hit that break-even point a lot faster. So really powerful stuff, guys. I'm not going to go into my entire policy here. I've done other videos on that. I'll link that down below if you want to check it out. But yeah, I'll go ahead and wrap up with that. That's basically front loading a whole life policy. I don't like to overcomplicate these things. It's just, if you're like me, you're not getting any benefit. You can see like you're not getting any benefits from having and saving money in the bank. You don't trust the banking system like I do. And you want to move that into a more efficient savings vehicle, a more efficient emergency and opportunity fund. Front loading is a great way to do it. All right. And all we're doing is contributing more in the first year than we are in the subsequent years. So, you know, not too complicated, but very, very powerful stuff. So I hope that was helpful, guys. If you have any questions, drop them down in the comment section below. Make sure you check out the description and go through all the links in there. I have tons of additional tools, training, and resources about this stuff to help you along your journey. And of course, as always, if you want to have a conversation about this and see if it might be a good fit for you, I'll have a link to my calendar as well. So I hope you guys are crushing it, and I will talk to you in the next one. To your success, Matty Ice is out.